In today's video, we are going to discuss the concept of taming a bear market. This has to do with using a whole life insurance policy, specifically in retirement, to hedge against a down market. A lot of people have used this strategy successfully over the years. I've seen it used on a number of occasions, and it's pretty interesting when you look at how you can use a life insurance policy along with other assets, especially if you've got a moderate-sized nest egg. Perhaps it's between $1 to $5 million. You're at that level where you say, hey, this nest egg I have generates, or if I'm going to have this much in retirement, it will generate enough for me to live comfortably. I can get my desired income from it. However, if there's a crash when I'm in retirement, that's where it can hurt me. Specifically, how has life insurance been used in this strategy, and is it a fit for me as you assess this overall strategy? So let's take a look here, and we're going to focus on the distribution phase. So if we look at the accumulation phase, we always talk about how to maximize the cash value of a life insurance policy and then use that life insurance policy, whether we're using it to invest in our business, real estate, whatever it might be. The stock market as a whole over time works. Like, you cannot say it doesn't. If we were just to look at a quick example here, go back to 1982, where I came up with 1982. That was before I was born, by the way. I was born in 1988. But if we go back to this point in time, if we just look at the stock market, so this is the Dow Jones. I just Google searched this. So today, it's just under 30,000 points. When we look at the actual market, come on. There we go. So we can look at what it did today, but let's go all the way back to 1982, which is as far back as we could go. Back then, the Dow Jones was just under 800 points. That was the value at that point in time. So if you were to go back in time and you had $10,000 that you could put in the stock market, do you think it would produce a decent return if you were to throw it in the Dow Jones and then you fast forward back in time and your money catches up with you? If that illustration makes sense. Would it be a good area to position money? Well, what you can actually do, you can Google search financial calculators. You don't need anything fancy here. You could just type in historical investment calculator. And let me just punch in that example. Let's say you've got $10,000. This website is financial-calculators.com. 10 grand, one-time investment, no. If I click no here, it'll assume that you're paying $10,000 per year. If I click yes, it'll be a one-time investment. If I want to start in 1982, which syncs up with that graph there, or the market history, what would it look like? This only runs to 2021, but you'll see my point. There's the 10,000 invested. Let's see what it looks like. There's the growth over time, investment gain or loss, ending value, $347,000. Total profit or loss here, we see a profit of $337,000. Because you started out with 10, now your value is 347. That's where the gain of 337 came from. So, as far as being part of the portfolio, yes, the market can work. If you can stomach it too. Speaking personally, I would have a hard time with it. Where I like to position my money is business, cash value life insurance products, and I have some commercial real estate. That's it. It's peace of mind. If I had money in the stock market, I'd be looking at it all the time, checking it all the time on my phone. Like, it's not my thing. Nothing against it at all. We work with a lot of people that have done very well with it, but it's not my thing by any means. Okay. So before we just jump to this spreadsheet, let me go back here. So the market works over time when I look at it as a whole. However, where it can hurt, where this strategy can really cause, let's call it financial pain for someone, is as follows. You are in retirement. You've built that nest egg up. You're taking income from that nest egg, and then we experience a market crash. That's where people have been negatively impacted by this. So in particular, let's assume that you've got a nest egg. Just going to use a simple example here of $4 million. You've built your retirement up over time. And if you were to earn, let's call it 5%, that would generate what? $200,000 of income per year. If we want to shoot it more conservative, if we plug it at 4%, that would generate what? $160,000 of income per year. This allows us to practice the classic strategy of I've got my large nest egg, I want to conserve the principal and live off the interest. Very popular. A lot of people have done that for years and are still doing it today. So that can work, but where people get hurt with this sometimes, not all the time, but sometimes, is when there's a crash during retirement. So if there's a crash, let's say the market loses 15%, what'll happen to your $4 million principal? If you're in the industry, you'll say it depends where it's invested. Generally speaking, what happens? I take a dip there. So if the value goes down and I want to maintain my same lifestyle, let's assume I'm taking income of $200,000 per year, this is where it can hurt me. Because one, the market's not earning 5%, and then two, I just took a loss on my principal balance. So how can life insurance be used as a hedge against this, particularly a down market? So if the market loses 15% or more, could be more or less, but right now it's lost a lot more. However, I'm very big on waiting out the storm. Personally, we work with professionals who are pro-stock market, involved in the wealth management side of the industry. We have nothing against it. So when we look at a cash value life insurance policy, what are the core benefits of the cash value when I look at it? And this is whole life insurance, not an IUL or a VUL. Well, specifically, the core benefits to a cash value life insurance policy: safe, liquid, and tax-free. The net internal rate of return, called the net growth rate over time, will produce somewhere between 3 to 5%. On an illustration, this will be referred to as your IRR, or your internal rate of return. Some illustrations and projections will look better than that. In reality, if a policy is properly designed, positioned with one of the major mutual companies where we've seen that proof of performance, that 3 to 5% is realistically what I would expect, just to properly set expectations. As time passes, the early years will be negative. You'll see that when we get to the example. So how this strategy works, specifically taming a bear market. So the market crashes, I don't want to pull from this anymore. What can I use as an alternative now? Well, if I have a big pile of money over in a cash value life insurance policy, it's $1 million, $2 million, whatever it might be. So I do have to have built this up over time. This is considered a fixed asset class. So what I can do now is I can stop taking income from here and begin to distribute, call it $200,000 per year from the cash value, provided I don't trigger a MEC, a taxable event that will be tax-free. There we go, for the next 5 years. So during that 5-year period, I'm taking income from my life insurance policy. All the meanwhile, I'm allowing the funds in the market, my nest egg, to recover, get back to that $4 million so I can flip on the income switch again. Let's see exactly what that will look like. So in this example, what we're going to look at is as follows. First, we're going to look at the growth of a policy. So this is based on an illustration here. We've got a high cash value policy on an individual who's 55 years old. So he's starting a policy. He wants to fully fund it before the age of 60, and he's getting $1 million in. Now, if we want to look at smaller numbers, this would work with $100,000 as well, which would be $25,000 per year, not $250,000 per year. As we look at this though, so here's our payments going in, $250 a year, total of $1 million. Here's your money column that reads net cash value, and then there's your net death benefit. This policy was designed with the minimum death benefit in mind, really to prevent a MEC from occurring. That's a taxable event. In summary, the goal was maximum cash value in this example. So let's scroll up here, not down. Quick side note. Anytime you look at a life insurance illustration, if I'm you, with the knowledge I have just being in the industry, the question I would ask is this. Of my $250,000 per year going into this policy, where is the money going? because my goal is to ensure that it is set up for maximum cash value. And how you know if it's set up for maximum cash value is exactly like this. Money can go toward one of two areas: the premium, or what is referred to as a PUA rider, which stands for paid up additions rider. Premium dollars typically do not show up in cash value in the first year of a policy, like this example, and very frequently with a traditional whole life policy, the first and second year of the policy. So if we were to scroll back down, we can actually see it here. You paid in $250,000 in the first year, and you don't have $250,000. You've got $211,000. That's a loss, which you don't need me to tell you that. This is the part when we're asked, what are the drawbacks to whole life insurance products when cash value is the goal? It's the upfront cash value. How do I minimize that hit as much as possible, get my break even as early as possible, which is when I have more money in cash value than what I've paid in, and ensure I've got maximum long-term performance as well. Here's how you do it: by reducing the premium as low as the insurance company that you're selecting will allow you to do so. So this company, this is Guardian here, they will allow us, wherever we set that minimum premium, the maximum we can illustrate here is 10x the base premium each year, provided the policy is set up properly with the right riders and such. So we've got this policy designed for maximum cash value. We looked at different assumptions here. This is based on the present dividend interest rate. For the remaining assumptions, what we're going to look at here is just everything laid out on Excel. So here we go. This is the example we just looked at. Whole life policy, 5.65% dividend interest rate. When we look at this guy, what do you notice? Exact same thing we just saw. $250,000 over 4 years, total of $1 million paid into the policy. Your break-even point, year 5. That's when you've got more money in cash value than what you've paid into the policy. The middle example, if we scroll our eyes to the right, this is the exact same policy, but exercising what is referred to as an indexed rider. This allows us, instead of just participating in the company's basic dividend interest rate, we can tie our funds to the S&P 500 index. How indexing works is if the market goes up, you go up with it. Market comes down, your principal is protected. There is a fee for that rider, however. This is based on the market history, so it does offer greater earning potential, but there is a fee when I exercise it. If I attach it to a policy and never use it, there's no fee. We've got a video that provides full detail on this indexed rider, which you can check out up here. So, as we look at this, internal rates of return look good. What I do want to hit on here, actually, very important, is a lot of times when people are interested in this strategy, we're going to look at the income shortly, they'll see a whole life insurance policy. Often they're exposed to it for the first time. And this company here has a dividend rate of 5.65%. Maybe I see a product that has a 6% dividend rate. If you hear the whole life insurance product you're considering has a 6% dividend rate, what do you automatically expect that your cash value is going to grow by? 6%. That's what most people think. That's what most people feel. Did I earn 6%? I've got $100,000 in cash value. How come it didn't grow by $6,000 last year? The dividend was 6%. The reason why is because the dividend rate is a gross rate. That's never what you're actually earning on a policy. What we want to look at here is our internal rate of return, the net growth rate as time passes. The annual internal rate of return represents what you're growing by annually. So what did I earn last year? If I look at policy year 10 here, 4.62%. If the dividend rate remains steady, as it changes over time, the internal rate of return will change over time. The average internal rate of return, what did I average over the past 10 years? 2.72%. So the average is going to factor in the early years. You see the same thing with the indexed rider, annual and average IRR. Then we also can look at the guaranteed rate too. If we want to see a worst case scenario, we do want to make sure we request the guaranteed rate or guaranteed values, which we've got over here, along with the internal rates of return. So let's take a look at the actual strategy now. So we've got the policy that's beefed up for maximum cash value. This one, before he even hits retirement at age 60, he's got liquidity here. So he can access his cash value for anything he wants. Perhaps he's investing in real estate, whatever it might be, he's got access to it. But the purpose of it is to tame that bear market. When things crash and he's taking income from that nest egg, so we go back to the $4 million over here, he wants to be prepared. So let's assume market crashes. He's got cash value in the example we just looked at, and he wants to pull $200,000 per year for the next 5 years. Let's take a look. On the left, you've got the growth example here. Let me fill that back in. So there's our growth example, same dividend rate assumption. And then over here, drawing income down just during a down market. So let's take a look at this. So what we're going to do here, we've got the funding, then we're going to assume at age 70, a correction occurs. Let's assume it's a severe correction where we need to take income from this policy for 5 years. Because our funds in the market, not only after the correction they'll start to recover, but I've got to give it time to get back to that 4 million if I want to continue the same income without touching the principal balance. This is a strategy that some people like to look at. So here we go. There's the $200,000 per year distributions. What we have here in this column, if I scroll back up, let me do that actually, represents your total payment, so $250 for 4 years, total payments, $1 million per year. And then when we have taken $200,000 per year for 5 years, what happens here? Well, there's your cash value. So you paid in $1 million, got your $1 million back, and you've got $800,000 remaining. If you were to die at this point in time, $1.1 million is paid income tax-free to your beneficiaries. Okay. Now at this point in time, we're going to stop taking money from the life insurance policy and flip back to the other assets. Let's see what this looks like. Age 84, we'll assume here, $200,000 per year again. And these are tax-free distributions because we did not trigger a modified endowment contract or anything like that. The $200K per year coming out. And now what's happened? Well, you pulled out an additional $1 million over 5 years. So you got your $1 million back that you paid in, plus another $1 million, all tax-free. We did this through loans without paying anything back. And what do you have remaining in cash value at the age of 89? Just over $290,000 and a death benefit of over $400,000 there, which is paid income tax-free. And then time progresses, right? And there's your policy values. Never lapses or anything like that. I don't know how far we want to go into our hundreds. So that is a very high-level overview of how that strategy works, taming a bear market. I will add, there's an alternative as well that people pivot back and forth. They don't have to pick the plan when they first start to say, this is how I'm going to use the life insurance policy. How you pivot here, if we're going to look at an alternative. Here we go. We will refer to this as a spend down. So what this looks like is taking retirement assets, spending them down, call it by age 85. Typically it's somewhere between 80 and 90. Let's say age 85 here. And when I say spending assets down by age 85, people who are concerned about leaving a legacy or generational wealth really like this strategy because if they have qualified accounts, right, which would be funds in a 401k, IRA, maybe it's stocks, bonds, mutual funds, money that when it is paid to, or passed on to the next generation, taxes are going to come out. If someone looks at that and says, hey, this is impacting my long-term wealth, my family wealth negatively here by leaving assets that have served me great in building my wealth over time with my stocks, bonds, real estate, mutual funds, everything. Now in the distribution phase or the legacy piece, it's not that great. So what some will do is say, okay, I'm going to take this nest egg over here of $4 million and spend it down. So I'm out of money, say by age 85, because I don't think I'm going to make it too much longer after that. If I think I'm going to live a very long time, then maybe I'll spend it down by age 90. However, we'll deliberately run out of money then, we'll project this, but all along the while, that cash value life insurance policy, this is part of the plan here, is on the back burner and just growing over time. So specifically how this works, let's look at a quick model, and then we will wrap this up. Before I jump to the actual numbers, let's do this. So this will be fun. Let's assume you've got $4 million. Same numbers we just talked about. $4 million, end of year, annual interest, let's assume 5%. If I am 65 and I want to go up until age 85, that would be 20 years. If I just live off the interest, you've got your $200,000. Very simple, pretty straightforward. However, if I want to spend this puppy down while still earning the same 5%, that would generate before tax just over $320,000 per year. And what happens here when I look at the account balance, I'm out of money by year 20. If I started this at age 65, by year 20, I'm 85 years old. Let's go a little bit longer. Let's go 25 years, because if we go back to the example we just looked at, when he started the policy, he was 55 years old, the life insurance policy I'm referring to, and he wanted to retire by 60. So if we're going to spend assets down by age 85, his $4 million nest egg, what would this look like? $283 per year. That is before tax. So that gives us a nice buffer to pay taxes, as tax brackets will change over time. They always do. Year 25, out of money. So at this point in time, if we go back to the life insurance policy, we can look at the illustration here as well. We've got this guy. Anytime you ever see Excel spreadsheets, I like them for simplicity. Make sure they're accompanied by the illustration, whether you're working with us or anyone. Very important to see that. So there's the funding for 4 years. And then at age 85, we're going to begin taking $250,000 per year. I'm going to go back to the Excel spreadsheet for simplicity. Okay, so let's take a look here. What we've got on the far right is that illustration we just looked at with income starting at age 85. So what do you notice about your cash value there when we take a look at that? Cash value, if we look at year 30, age 84, you're at 2.99, just about $3 million in cash value. However, because we've spent everything else, well, firstly, if we die at 84, $3.5 million is paid income tax-free to our beneficiaries. Now, what we're going to do is start to pull $250,000 per year through the age of 100. What is in red over here is your total payment. So you paid in $1 million, and then how much did you get out in this example? Your initial $1 million plus another $3 million by age 100, right? So we're taking a lot out. Most people look at it and say, there's no way I'm going to spend $250,000 per year in my 90s. I'm going to slow down and kind of enjoy myself just at home at that point in time. If we've slowed down just from a lifestyle aspect. Some people move fast, completely up to the individual and their energy levels. But anyway, there's the policy where I continue to take out the desired income of $250,000 per year through age 100. Maybe I scale it down if I only need $100,000 or $150,000 per year. If I'm taking less, what will happen is the values will be higher. So if I take less out, naturally I'll have more cash value and more death benefit as well. So I hope you enjoyed this video. It's an interesting strategy that really just involves looking at what we've got going on with our nest egg. If I'm in the accumulation phase or the distribution phase, how can I use life insurance, if at all? Does it fit into my personal situation? It's just really looking at the numbers at the end of the day. Hope you enjoyed this one. If you did, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks so much.
Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.